Today we're having accounting class, and I would like to take you guys through on how to prepare an account for business transactions from January. Okay, let's say January 2025, and the business owner started the business with a capital sum of £500. I hope you guys can see it. A capital sum of £500. Okay, on the 3rd of January, they bought goods for cash, £85. Okay, and on the 7th, they bought goods on credit, £116. On the 10th of January, they sold goods for cash. On the 14th, they returned goods worth £28. On the 18th, they bought goods on credit worth £98. On the 21st, they returned goods worth £19. On the 24th, they sold goods worth £55. On the 25th, they paid a creditor £88. And finally, on the 31st, which is the last day of the month, a debtor paid £55 into the business. Okay, so we're going to be preparing different accounts. Okay, but before we go into that, I would like you guys to understand this equation here, this accounting equation. So for you to be able to open different accounts and know how to categorize it, okay, you have to understand the concept of debit and credit. Okay, so there is this concept of double entry bookkeeping system that states that every debit entry must have a corresponding credit entry. Anything that you debit, any transaction that occurs in a business that you had to debit, there must be a corresponding credit entry. There must be a corresponding credit entry. And I've listed out what goes as a debit and what goes as a credit. As you've seen here, debit side we have assets, expense and drawing. On the credit side we have capital revenue, which is also called sales, and then liability. I don't want this video to be too long. It looks like we're going to be splitting this video into, okay, we might not be able to finish it, but let's see whether I'm able to merge all of this together. I don't want it to be too long, maximum 12 minutes, right? And this is the accounting equation that sums up the financial statement. So in this question, we're going to be preparing different accounts, and then after we've done the open different accounts for each of these transactions, okay, we are going to prepare a trial balance, and from that trial balance we will prepare our income statement and our balance sheet, right? In case if I'm not able to finalize this, okay, there will be a second video for this, right? Okay, so let's start off with the capital. So guys, for convenience sake, I'll be using paper instead of using computer. Okay, so I've drawn T account. This is called ledger accounts. Okay, so this is the accounts that we're going to be opening. So the first question said that we started business with £500, and if you start a business with an amount of money, you call that capital. Okay, we call that capital, and we call here debit and here credit. Okay, whatever that is coming into a business is usually an asset. Okay, and it has a default debit balance, and whatever that goes out of the business is a credit balance, but not always the case. But in most times, yeah, debit is something coming into the business, and credit is your expenditures. Debit is what comes into the business, and the credit is when amount is leaving your bank account, or when there is a liability, or when there is a sale. Okay, so I'm going to repeat it here again. Debit, credit, all these things has a default either credit or debit balance. Asset has a default debit balance. Okay, expenses has a different credit balance, and drawing, when you are taking off things from your business if you're a business owner. And what goes into credit side is your capital, your liability, and this capital can equally be called equity. Okay, your liability and your revenue. Okay, which can also be called sales. So with this, it will guide you on which side of the T account you are going to record this. So we started a business and we started with £500. So it's going to be a default what? Credit balance. Okay, that's why we credited it on the credit side. And what is going to be the corresponding debit entry? You remember what I said earlier? Every debit entry must have a corresponding credit entry, vice versa. So we have a default credit entry of £500 that we started business with, and it goes into our bank, okay? Because this is where you keep your money, either cash at hand or cash at bank. But in this case, we're going to be using bank. So here is debit and here is credit. Money is coming into our bank and we have to do what? Debit 500. You see, it's balanced. Credit side, debit side. Okay, that is done. So moving on the 3rd of January, we bought goods for cash. We want to start selling stuff, so we have to purchase an item, and we bought those items or those inventories cash. We paid outrightly cash to purchase those. So you're going to ask yourself, what is going to be the double entry? Okay, so we're going to use this one. We're going to open a new account now. So we purchased goods, how much? £85. So we're going to call this inventory. Let me place my book properly. Inventory, or you call it purchases. And this is debit and this is credit side. Okay, okay, so it's going to affect two accounts. It's going to affect our inventory accounts, and because we paid with cash, okay, we paid immediately as soon as we purchased it, we paid right there, right? So it's going to affect our bank. So because an inventory is an asset, okay, inventory is an asset, so we're going to be having a default debit balance of £85. Okay, goods 85. And what is going to be the corresponding credit entry? It's going to be bank, because £85 is leaving our bank. Okay, we bought goods, we say £85 credit. Okay, this amount has reduced the initial money we have in the bank. Okay, so on the 7th of January, we purchased an item on credit. This time around, we did not pay anything. Okay, we didn't pay anything. Probably this supplier, we already have an agreement with them that we're going to pay them in the next 30 days. So we carry the goods without payments. What is going to happen? One, the first thing is we purchased an inventory, and it's going to affect our inventory account. How much is that? 116. So we bought goods again, 116. And which account is it going to affect now? You see, it's not going to affect our bank, okay, because we haven't paid it. It is going to affect another account called payables or creditors. Payables/creditors. These names are interchangeable. This is debit and this is credit. Okay, So because we haven't paid this supplier, payable is a liability. It belongs to this here, and it has a default credit balance. And because we have debited here in our inventory, we must credit goods 116, and that is done. Moving on. So on the 10th of January, we sold goods for cash. We made our first sale, the first ever sale we made, and it was for £42. Okay, so this time around it's going to affect our bank because money is coming into our bank, and it's going to affect our sales. So we're going to open another account called sales ledger. Okay, sales, debit, credit. And you remember here we mentioned that revenue or sales are usually credit defaulted. Okay, so we made a sale of how much? Sales £42, and because we made that sale, they paid, the customer paid right there and then. Money is coming into our bank, so we're gonna debit money coming into our bank. Sales £42, and we're going, this time around it's going to affect 3 accounts. And because our inventory, we sold an item, our inventory is going to decrease our item. Imagine that you are selling orange, and you have 5 orange in your shop, and you sold 3. Okay, you see your inventory has decreased, so you have to register it so that we can always keep stock of the remaining inventories. So we have sold an item for £42, so we're going to record it here, sales £42. You see, this account affected 3 accounts. It affected our sales, our inventory, and our bank. Okay, you see, some transactions might actually affect more than 2 accounts, but it can never be lower than 2. Okay, so the least is 2. It can affect 3, 4 accounts, but yeah, it cannot go below 2. Right. So moving on the 14th, we returned goods. We returned goods that we initially purchased, and that goods is worth £28. Okay, we returned goods. Remember, we purchased an item initially, but we choose to return probably because it's a faulty item, right? When we return goods, we have to open a return account. And this is debit and this is credit. And because we are the one returning, okay, it is going to be a credit balance. Okay, so we return goods worth, how much is that? £28. Return £28. And remember here, this account payable, we purchased goods from a supplier. Because we haven't paid them, we opened account payable. Okay, but this time around we are returning some of those goods back. Hence, we have to reduce the amounts that we returned. Okay, because if we don't reduce it, our accounts will still be showing that we owe these people 116. However, we have returned goods worth £28. In that regards, we're going to be writing here return. Let us record here. So in that regards, we're going to be recording here return £28. You see, this one affected 2 accounts. It affected return account and payable accounts. So we don't owe them 116 anymore. We have to reduce it by £28. Okay, so moving on now. On the 18th, we bought goods on credit worth £98. Okay, we bought goods on credit worth £98. So because it's credit, we have to record it here because we haven't paid. Okay, and it's worth £98. Okay, and because we purchased an item, we purchased an inventory, our inventory is going to increase, so we're going to record it here, £98. You see, debit here and credit here. Okay, that is done. Moving on the 21st, we returned another goods worth how much? £19. So we're going to go to our return account again, return 19, okay, and the return here in our payable 19, okay. Now on the 24th, we sold an item worth £55, okay. We made another sale, so on here on our sales account, sales £55, and our inventory is going to decrease £55, okay. So we recorded our sales £55 and our inventory reduced £55. However, this customer haven't paid us. The customer is owing us, and therefore we have to open another account called receivable or debtors account, okay. This is debit and this is credit. Receivable is an asset, okay, and asset has default debit balance, so £55 sales. You see, these sales affected three accounts. It affected our receivable, it affected our sales, and it affected our inventory, okay. So now the business made a payment to a creditor worth £88, okay. We made a payment first and first, so the business paid a debtor. So how do you record it when you make a payment? Of course, it's going to leave your bank, okay. So we're going to say paid. Usually the name of the customer has to be here, or the name of the supplier rather. So we paid how much? £88, okay. And because we've made a payment of £88, our payable is going to reduce, okay. Now we paid how much? £88. The reason why we are debiting it is because payable is usually a default credit balance, okay. So you debiting it is reducing how much you owe your creditors or your suppliers. So we've recorded it here, money left our account £88, and we have to also reduce it by £88. It's a debit and credit, okay. So finally a debtor paid us, right? A customer that owes us paid us. How much did the customer pay? The customer paid the sum of £55, okay. Remember, this customer that we sold an item to, they paid us. What we're going to do now is, we initially recorded it as receivable. Now they've made the payment, we're going to decrease it, okay. We're going to write here paid £55, and when a payment is made into the business, money is going to come into the business, and hence we say sales £55. We have debited here, I hope you guys can see, we have debited £55 and we have credited £55 here. Right, now we are going to close off the accounts, okay.